Welcome back to Morning Trade Live. One of the most reliable parts of the bull market this past 5 years has been under fire from Morgan Stanley. Talking about technology, of course, most specifically today, analysts at the company saying that chip stocks presenting a poor risk to reward ratio. I want to bring in our guest, Scott Bauer. He's the CEO of Prosper Trading Academy, in studio with us today. We're warming you up for your fast market hit.
Love it.
All right, Stephanie Lewicki, Senior Manager of Futures and Forex, also with us, and Scott Connor, host of Virtual Trade. Scott, you worried about tech? We're worried about semiconductors. Morgan Stanley is really pounding the table on this.
Yeah, they are. I mean, I think anybody that's been in the space and has been along for the ride, you have to be a little bit cautious, right? Just from a risk management standpoint. That being said, the more I looked at what Morgan said, and I'm looking at my notes here, they still like a bunch of the companies out there on the likes of NVIDIA, Xilinx, Amba, Intel. So to me, and listen, I'm no Morgan Stanley, right? To me, their call is more of, okay, if you've been in it, take a little bit off the table here. I don't see the near-term future here, this sector imploding. I really don't.
It's kind of an interesting follow-up because this began with the chief strategist in the wealth management business, Mike Wilson. Stephanie, we talked about at the time when this call came out about a month ago, saying that tech is going to be hurt and semiconductors will be subject to the tariff pain. But the analysts here, once again, becoming more specific here, because Wilson also has a target for the S&P 500 at the end of the year that's 2% changed. Right. So net, the move on the S&P might be limited, but now they're drilling in even deeper and saying, look, certain semis, there are semiconductors exposed to the cloud space and some of the CapEx spending, those ones are okay.
Yeah, they did, just like Scott said, there were certain ones they liked and those were related to the cloud space. And now they're looking at this, but they're saying the ones that they are negative on, and this article is saying that their growth is just going to be stagnant over the next 6 to 12 months. And they think some of this is related to some of the deteriorating relationships that we have between the U.S. and China right now that could lead to some of the decline in these stocks.
Now, this has got to, though, it feels to me just like a call again. All the tariff stuff seems so difficult to really pin what the earnings read through is. I mean, we've talked about this just ad nauseum this quarter, right, Scott? Which is that yes, there are companies mentioning tariffs more than ever than ones that you can attribute to a drop in the overall earnings are pretty limited. Some of the companies have drawn back their guidance, but to come out and say this is going to hit the semis even more based on tariff concerns that aren't really related to semis yet. They might be, right. But even for the companies where we know the tariffs are hurting, the steel and aluminum stuff, it hasn't changed the dynamic of their sector really that much at all.
Right, and I think the tone of this article wasn't so much a bearish call as that they think we're moving maybe into a sort of a range-bound period for the semiconductors, and again, pointing out certain companies. But I think of the three things, tariff is probably lowest on the list of what concerns them the most. I think this is more of a cyclical concern,
right?
With built-up inventories and longer lead times and things like that. I think if there was a drop-off in demand, that could really sort of catch them by surprise. That was one thing, and the other one was just looking at the overall move that these stocks have made. If you look over the last 3 years, tech itself is up about 81%,
yep.
But the Philly. I think the semiconductor index is up over 100%.
Exactly.
So,
yeah.
and the market itself, the S&P up like 30, 35%, something like that. So they're just sort of putting things in perspective. And if you start looking at individual stocks like NVIDIA and AMD, these stocks are up in the last 3 years 1,000%. So I think you're actually right. I think it's more of just sort of a cautionary note, and that if we do move into a sort of a sideways range-bound period, to be ready for that as an investor.
Scott?
I agree absolutely with what Scott said, and especially looking at the SOX, the Philly Semiconductor Index. One of the big things I took out of that, though, is one of their concerns is that all of the M&A that we've seen over the last couple of years that has really fueled and put a lot of rocket fuel behind this space, they're looking that may be curtailed now because of the China tariff issues. So again, that's just one other reason I think that, like Scott said, it's not necessarily a bearish call, it's maybe just a little bit of a risk off, take your money off the table call.
And to their point, we have seen examples of that, right? Broadcom, Qualcomm,
yep.
NXPI, another one, the impact that had on some of the suppliers as well. Stephanie, when we look at volatility, though, again, when we come back to this conversation, maybe you take as a trader and process what Morgan Stanley is saying, and then you look at VXN or VIX or any, pick your volatility measure back to the lows post-February. So then just protect yourself, right? Is that the answer?
Right. VIX has a 10 handle right now, and to hedge now, if you agree with this analyst and think that if you have a position in these semiconductor stocks, or even if you agree with what they came out with 2 weeks ago and had that overall bearish, there's going to be a correction worse than the February 5th correction, hedging is very cheap right now with the VIX at 10. You can't go wrong if you are concerned with where the VIX is now. It's cheap to hedge.
Guys in the control room, bring up VXN as well, the CBOE NASDAQ VIX, because Scott, this I think is pretty astounding as well, given the narrative that sometimes has been told around tech and the pain post Facebook, and then all these valuations are getting ready to crumble. Not saying that can't happen, but we just had a conversation with Nick Coles at DataTrek about the role of dispersion and how it might contribute to the lower volatility. You've got things going in different directions, lack of correlation, hard to get big swings in the broader market. So you look at this as a trader, is there an opportunity here to basically go in and either, buy protection from individual companies, buy protection on a benchmark level?
Absolutely. And first, let me point out, you can go wrong, Stephanie, because I've been long some upside VIX calls over the last, little while here, and it's in not doing so well. But Oliver, you make a great point.
So you're selling Mark Sebastian his ammo.
Exactly. But you look at this here, and how can you not go in and buy this cheap protection? It's astounding to me where this is trading, given all the market risks, given the geopolitical risk, given the tariff talk. It's astounding to me. Now, we saw this happen in January. We saw what happened early February, but we're in a different time. We're in a different space right now than we were in early February. So I don't correlate where we are in the market, where the VIX is right now, to where it was earlier in the year. It's a completely different time.
Scott, as I'm going to warm you guys up for fast market and warm you up for virtual trade. We've talked about this before. Let's say you own Qs and you see a report like this, or let's say you own SMH, the ETF that tracks the stocks. Do you go and buy protection on an individual company that has a big weighting in there? Do you own a put in an Nvidia or an Intel, or do you try and just play within the benchmark sort of ETF that you're in?
Yeah, I think for investors who had these big returns in these chip makers, if you were to go in and protect each one individually, that might be a little laborious, to get all that done. I think with the index, like we just pointed out, being as low as it is, such a low volatility level, it kind of sets itself potentially up for someone, if you are going to buy protection, now is actually a desirable time to do that. Now the thing is, a lot of people own these stocks that are up 1,000%, we were talking about, the Nvidias and the AMDs. Maybe they don't want to sell those stocks. So again, the question becomes, how can I protect that group of stocks without actually selling the individual stocks? And like you just mentioned, maybe looking at one of the stock sector indices and doing something on a bearish note, like maybe a long-term put spread, something like that, to give some potential downside protection.
Yeah, other Scott?
So another thought process to that, because volatility is so low, if you've been along for the ride, you can exit out, just exit out of your position, but buy some upside calls with volatility so long. So this, volatility is so cheap. This way, you still have exposure to the upside, but you've taken, your risk really off the table. So if it goes down, okay, you sold out, you lose a little bit of premium to your upside calls that you bought. If it goes up, you've got really cheap upside exposure. So that's just another thought process.
Stock replacement, basically, yeah.
Stephanie, I'll give you the last word on this. Does all of this matter, though, if we've got an earnings for tech, and if I think we've got this, bring it up, guys, 50% EPS growth, and they're also beating, and the fact that they've got a 90% beat rate is just, it's sort of almost tough to reconcile with this until you look at the move that happens after these companies, and for the most part, they're down after earnings, which is a strange sort of combination for some.
Right, and we'll relate back to your Facebook and Twitter and what happened to them, and really what could possibly happen. Now, these are different types of companies, but also this earnings season, if a company misses, they're missing 3 times the amount that they did last quarter. So it's a little different environment this quarter with the earnings than it was last Q1.
Yeah, and you see tech, even when they are getting sold off. All right, guys, great conversation. We're going to take a short break. We're going to come back and talk mergers. Some of the less discussed ones with those big mega deals in the works, but 2 now that just got canceled. One that has to do with content and television. The other about pharmacies plus grocers, 2 areas that have been under pressure, and they both got the kibosh. We'll be right back on the TD Ameritrade Network.
It's high time to power up your portfolio, explore ways to reduce risk, and take control of your financial future. Join me, Scott Connor, a 30-year veteran trader, as I dissect trading tools and show new trader Jenny Horn how to construct a long-term investing plan.
I'm kind of starting from scratch. This is awesome. I've never used trend lines before. I do like the growth stocks. They're like hipper and they're fun and they apply to a lot of millennial traders like myself.
Only on the TD Ameritrade Network.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
All right, let's do it. I'm Oliver Rennick. Welcome. We're live from the NASDAQ.
The NASDAQ, the ES, the Dow, the Russell.
If you search classic bubble on Google, this is what comes up.
You're going to see that we've taken, I think, a very deliberate approach to it.
What are the CEOs saying about earnings going forward?
You and I both know everything starts small.
Blockchain technology, we think surprisingly AI is going to have a role there.
So let's just jump right into the Thinkorswim trading software.
Being a young trader, I do have lots of goals, I guess, because I'm kind of starting from scratch.
We're going to talk technicals versus fundamentals. You can't argue with the chart that you put up.
After this right here, people start saying, okay, maybe it's time for the dollar to take a little bit of a break.
That's providing that kind of price activity that's screaming, yo, you, look at me.
Check us out more online at the TD Ameritrade Network.
Welcome back to Morning Trade Live. It's time to talk mergers. I want to bring in our panel. Bring them back. Scott Bauer, Scott Connor, and Stephanie Lewicki are still with us. Scott Connor, this is a pretty interesting development, but for some maybe not terribly surprising. Let's start with Rite Aid and Albertsons. So this deal now off. We're going to talk about the Tribune deal as well, and Sinclair Broadcast Group. Let's start with the grocer pharmacy. For many, this was doomed from the beginning, and that ended up to be how it actually turned out.
Yeah, absolutely. And I think one of the main takeaways with both of the stories we're covering here in this session is that, you know, as a trader, long-term investor, this happens from time to time. Mergers don't always work out. I mean, you can get close, but like I think I heard someone say, until the I's are dotted and the T's are crossed, it's not a done deal. So these things can happen. As far as this particular merger goes, it's kind of interesting because many felt this would sort of be beneficial for both sides, but obviously once this news came out, Rite Aid actually took a bit of a hit. I think they were down, what, 10, 11%?
They're down 11% right now,
11%?
which for Rite Aid is the equivalent of about 10 cents.
Exactly.
But nevertheless, you know, if you
Percentage standpoint.
yeah, if you you know, put $1,000 in here, today's not a great day. You know, Scott Bauer, you look at this, and you know, the Rite Aid Albertsons is like a fly in, you know, the comparison to a giant deal like, you know, the Disney Fox stuff. But I think Scott's lesson is important here as well, because two struggling enterprises that you might say, look, this has to happen for their survival, but that doesn't always have to be the way it plays out.
Absolutely not. And just because you have two struggling businesses doesn't mean that a merger of the two is going to make things better. When I delved into this a little bit more, I saw that Albertsons already has $12 billion in long-term debt. So I think actually for them in the long run, this could be a net positive that they don't do this. I know they wanted to get into that space. I know they wanted Rite Aid, but you know what? To take on that massive amount of debt, I just don't see that as a great thing. Now, from the Rite Aid side here, they've already sold off, what, 2,000 of their stores, I think. And to me, this is one that, you know, it's a dollar and change stock right now, and it may be a single-digit stock because this to me was their lifeline. I know their board doesn't want this. To me, this was their lifeline, and you know, just because we're down 10%, doesn't mean it can't fall further.
Yeah.
And I agree with Scott in saying this could be their lifeline. And I think, you know, this is happening in some of the other mergers, as we can see. The Cigna and Express Scripts is really with Amazon coming in now and buying PillPack and getting into this business. And that's, where Albertsons wanted Rite Aid, the pharmacy, in there, because there's going to be some of this other competition that's coming from Amazon. And we saw what happened with when Amazon announced this. When Amazon announced a deal a couple months ago to buy PillPack, you had Walgreens hit hard by it. You had Rite Aid hit. You had CVS. They all got really hit hard by that. So maybe some of these companies are not scrambling, but looking to do deals that aren't the best deals because they know this competition is coming up from the likes of Amazon, and so that's where hence this deal is not going to get done when shareholders really look at it and vote, no, this doesn't make sense for us.
Does this then strike you as another sort of I don't know how to put it, but a notch on the belt of Jeff Bezos for knocking another company out? I mean, this is their lifeline and they missed it.
It does. It does.
Yeah. Scott, this is also, I think, interesting because we just saw CVS earnings. They actually did all right for the first time in a while in terms of how the street reacted to it. But the industry is under pressure, and this tells us that whether you're public like Rite Aid, private like Albertsons, I mean, the pressure's not going away. There's going to maybe be an attempt for something like this or more stores sold off. It's not the end of the story for Rite Aids.
Not at all. And I was just thinking as Stephanie was talking about Bezos and Amazon and maybe there's a point here that Rite Aid gets so beaten down that Amazon just comes in and says, you know what? This makes sense to take them out. Whether it's an added value to Amazon or not, or just to remove them from the marketplace so that Amazon, with their merger with PillPack or their relationship with PillPack, so it accelerates that. I wouldn't be surprised if we start seeing that now.
Someone needs to do analysis of the location of Rite Aid stores and Whole Foods stores and figure out if they're not too close together, then maybe it makes sense to get some of those brick and mortars. Mr. Connor, the Sinclair Tribune breakup, a little bit different, right? Pressure from regulators that were signaling they didn't like the deal, and then it gets cut off, and now there's lawsuits. This gets a little bit
this
messy.
is more on the ugly divorce side, I would have to say, of the two mergers, because in the Albertsons deal, there were no negotiation fees for pulling out of this. And it's a long story there, but quite a bit different on the Tribune. Tribune is actually turning around and counter-suing for $1 billion, claiming that Sinclair was negligent in meeting the terms of the agreement. So there's still a lot more to come from this one in terms of hostile sort of breakup, if you will.
Yeah, they're saying that Sinclair basically acted aggressively in this pursuit and didn't sell off certain parts of their local TV business that they could have to make this work, Stephanie. So, did the FCC kill this thing before they could have even gotten to this point, or what?
I think so. The concern is there will be too many local television stations with the combination of the Tribune Media Group and Sinclair Broadcasting, and like you said, Sinclair wasn't selling off enough of these local television stations, and I think Fox was in there somewhere where they were going to sell some to Fox, and then they backed out on that. So it almost, Oliver, I probably would agree, it was kind of doomed from the beginning.
Yeah, the shares for Sinclair are down about 2%. Tribune's on the upside, but you look at the numbers there for Sinclair, they're pretty solid in terms of the growth. Mr. Bauer, what do you take away from this? Is this just another example of why you got to be careful trading M&A?
No question about it. And like Scott said earlier, there's no guarantees that any of these deals happen, and they typically take longer than expected. And you look at this one where the FCC is involved, and this is just going to get protracted. I would not be surprised if 3-6 months down the line, this gets revisited. That part of the ugly divorce that you talked about, that there's some talk on the side here, and maybe something comes about of this again.
Yeah, all right, well, we've been used to seeing a lot of drama in the M&A front this year, but continues once again this morning. Great stuff. No drama on the panel here. Scott Connor, Scott Bauer, and Stephanie Lewicki with us. Great stuff all around the board, guys. All right, Fast Market is up next. Mr. Bauer is now ready to roll. He got his MTL prep. He'll be joining the traders for Fast Market Virtual Trade at 11. Mr. Connor, Real Talk, and then Midday Movers before I see you guys back at 2 p.m. Central Time for Market on Close. I'm Oliver Rennick. Thanks for joining.